The Trade Desk Inc., the world's largest independent demand-side platform, enabling advertisers to programmatically buy inventory across connected TV, mobile, display, and audio at scale.
TTD generated $2.9 billion in FY 2025 revenue at 79% gross margin. Q1 2026 delivered a revenue beat alongside an EPS miss that sent shares down 14%.
Jeff Green co-founded The Trade Desk in 2009 in Ventura, California, building the independent DSP alternative to Google after co-founding and selling AdECN to Microsoft in 2007.
The 2016 NASDAQ IPO doubled on day one. By 2020, connected TV had become the dominant growth driver as streaming fragmented linear TV advertising budgets.
Kokai AI reached 85% client adoption by 2025. UID2, the open identity standard, surpassed 313 verified data and publisher partners. Trade Desk joined the S&P 500 in July.
The Trade Desk earns a percentage take rate on advertising spend flowing through its platform. It owns no media inventory and earns exclusively on the buying side.
Video and CTV generate 52% of revenue. Mobile contributes 28%. Display and audio account for the remaining 20%. The U.S. drives 82% of total revenue.
FY 2025 revenue reached $2.9 billion, up 18% year over year. Gross margin held at 79% as platform mix stayed favorable. Kokai processed 13 million impressions per second.
Q1 2026 revenue $689 million beat estimates, but non-GAAP EPS of 28 cents missed the 32-cent consensus. EBITDA margin compressed 400 basis points to 30%.
Google DV360 and Amazon DSP dominate programmatic buying, but both own media inventory, creating conflicts of interest. Trade Desk's independence and neutrality is the platform's structural moat.
Kokai AI drives automated campaign optimization across the open internet. UID2, Trade Desk's open identity standard, has over 300 verified partners as third-party cookie deprecation accelerates.
Magnite operates the sell side. Smaller independent DSPs lack Trade Desk scale, agency relationships, and data partnerships. Open internet advertisers consistently choose neutrality over walled garden reach.
The United States drives 82% of Trade Desk revenue through large agency holding companies, independent agencies, and direct brand partnerships running CTV, display, and mobile campaigns.
Europe and Asia Pacific represent the 18% international share, EMEA adoption expanding through UID2 publisher partnerships under GDPR. Australia and Japan lead programmatic CTV growth in Asia Pacific.
Jeff Green is co-founder, CEO, and chairman. He founded AdECN, the first demand-side ad exchange, sold it to Microsoft in 2007, and launched The Trade Desk 2 years later.
Green holds a BA from Brigham Young University and a marketing communications degree from USC, and has led The Trade Desk as co-founder, CEO, and chairman since 2009.
The Trade Desk, the independent DSP, $2.9 billion in FY 2025 revenue at 79% gross margin, with CTV, Kokai AI, and UID2 as the structural growth levers.
Q1 2026 revenue of $689 million beat estimates, but non-GAAP EPS of 28 cents missed 32 cents estimated. EBITDA margin compressed 400 basis points. Q2 guidance of $750 missed street consensus by 30 million. Stock fell 14% in after hours.
The Trade Desk just reported Q1 2026 results, and the headline is not the revenue beat, it is the earnings miss. Revenue came in at $689 million, 11% above last year, but earnings per share landed at 8 cents against a consensus of 25 cents. That is a 68% miss. Tonight we break down what happened, whether this is a stumble or something bigger, and what it means for the open internet thesis.
Let us start with who the Trade Desk actually is. Founded in 2009 by Jeff Green and Dave Pickles, the Trade Desk is the dominant, pure-play demand-side platform in programmatic advertising. A demand-side platform, or DSP, is the technology buyers use to purchase digital ad inventory across the open internet, including streaming television, podcasts, display, and mobile.
The company sits on the buy side. Publishers sell inventory through supply-side platforms, and buyers access that inventory through the Trade Desk. Their full year 2024 revenue crossed $2.8 billion. They serve agencies and brands in over 40 countries. And critically, they do not own media. That independence from content is a key part of the value proposition. No conflict of interest, full transparency on where your ad dollars go.
Now, the earnings. Q1 2026, revenue of $688.9 million, up 11.8% year over year and above the company guidance of at least $575 million. On revenue, they beat. But that is where the good news ends for the quarter.
Earnings per share came in at 8 cents on a GAAP basis. The street was expecting 25 cents. That is not a slight miss. That is a 68% shortfall. Gross margin compressed to 73.6% from 76.8% a year ago. Operating income was $66.6 million, and the operating margin fell to 9.7% compared to 30.3% in Q4 2025. That sequential drop is severe and warrants a serious explanation.
Three forces collided in Q1. First, the cost structure is expanding. Research and development spending increased significantly as the company accelerates investment in Kokai, their AI-powered ad buying platform. Sales and marketing costs also rose as TTD pushes international growth. Second, macro pressure. Advertisers pulled back on discretionary spend in Q1 as tariff uncertainty and consumer confidence concerns weighed on ad budgets. The Trade Desk operates in a cyclical market. When brands get nervous, programmatic budgets get cut first.
Third, platform transition friction. TTD is migrating clients to Kokai, and mid-cycle platform overhauls create temporary disruption. Some spend can shift elsewhere during transitions. Jeff Green acknowledged on the earnings call that Q1 was not the quarter they wanted to deliver. He pointed to macro softness, not structural market share loss, as the primary culprit. Free cash flow remains strong at $279 million, which provides some reassurance that the business still generates real cash, even when GAAP earnings disappoint significantly.
Jeff Green has been at the helm since founding the company in 2009. He is one of the few founder CEOs in ad tech still running the company he built. Green is known for his evangelist approach to the open internet and has been vocal about what he calls the battle between open platforms and walled gardens. He owns a significant equity stake and has consistently framed TTD as a long-duration infrastructure bet on the future of programmatic advertising.
Let us talk about what is ahead. Management guided Q2 2026 revenue of at least $730 million, which would represent roughly 9% year-over-year growth. That guidance came in lighter than buy-side expectations, and the stock has already reflected that disappointment. Shares are down dramatically from their 52-week high of $91.45, currently trading near $23.
But the forward narrative has real catalysts. Connected TV remains the fastest-growing segment within TTD. The streaming ad market continues to expand as linear TV viewership declines and platforms like Netflix, Disney Plus, and Peacock scale their ad-supported tiers. TTD is plugged into all of them through direct integrations. Every new streaming subscriber on an ad-supported plan is incremental inventory for the Trade Desk to activate. CTV is still in early innings, which means the volume ceiling is still rising.
Retail media is the second major tailwind. As major retailers monetize their first-party shopper data, they increasingly plug into programmatic infrastructure, and TTD is positioned to be the DSP of choice. Unified ID 2.0, or UID2, is the identity layer that makes this work at scale. UID2 is an open-source, privacy-preserving identity solution built to replace third-party cookies. It has been adopted by major publishers, retailers, and demand-side players. When Google completes its privacy sandbox transition, the question will be who owns the non-Google identity graph. TTD is building that answer right now.
The competitive picture is where bulls and bears diverge most sharply. The Trade Desk operates on the open internet, the web outside the walled gardens of Google, Meta, and Amazon. The bull case says the open internet is under-monetized, that advertisers are over-indexed to walled gardens, and that measurement advances will eventually shift dollars back toward the open web. The bear case says the measurement gap never fully closes.
Amazon is the most direct competitive threat in the near term. Amazon DSP has grown aggressively, leveraging its own first-party retail data in a way that TTD can only replicate through partnerships. In retail media, Amazon controls the most valuable shopper data on the planet and is increasingly letting brands buy that data outside of its own properties. That is structurally what TTD does, but with data assets, TTD simply cannot match. This is the core challenge the trade desk must navigate without owning any major first-party data asset of its own.
The bull case for the trade desk starts with a number: 95% customer retention. That figure has held steady for years. When a large ad agency builds its programmatic infrastructure around TTD, they do not leave easily. The switching costs are high. Integrations, training, workflow, and data histories are all deeply embedded. This creates a durable revenue base that makes the business model far more resilient than any single disappointing quarter suggests.
Beyond retention, the total addressable market is still expanding. Global programmatic advertising spend is projected to exceed $600 billion by the end of the decade. TTD currently touches a fraction of that. CTV is still in early innings. Most streaming inventory is not yet fully programmatic. As it gets there, TTD has the deepest integrations and the clearest targeting infrastructure. UID2 adoption is accelerating, meaning TTD is building the pipes the entire industry will run on. $279 million in free cash flow this quarter gives them the balance sheet to invest through the cycle.
The bear case deserves equal weight. Q1 2026 showed margin compression that was not gradual, it was sudden. Operating margin fell from 30% in Q4 to under 10% in Q1. That is not just seasonality. The cost base is expanding faster than revenue, and the Kokai platform build is consuming capital now, with payoff timelines that remain uncertain. If macro headwinds persist into Q2 and Q3, TTD could face multiple quarters of earnings pressure with no clear bottom in sight.
Valuation is also a concern, even after the sell-off. The stock traded above $90 less than 12 months ago, reflecting expectations that were clearly not met. At $23 today, the market cap is still $11 billion, roughly 16 times trailing revenue. That is not cheap for a business with sub-10% operating margins in its most recent quarter. If Q2 guidance also disappoints, the multiple could compress further. Amazon DSP keeps gaining in retail media, the very segment that was supposed to be the next major growth driver for TTD. The risk is not that TTD disappears. It is that the growth story takes years longer than bulls expect.
So where does that leave the investment thesis? The Trade Desk's a company that was priced for perfection for most of the past 3 years. That perfection has not materialized in Q1 2026. The question is not whether this is a great business over a 10-year horizon. Structurally, it probably is. The question is whether the current price reflects appropriate risk-adjusted expectations given 2 to 4 quarters of likely execution uncertainty ahead.
The setup could be compelling for investors with a 3+ year horizon who believe in the open internet thesis and UID2 as foundational infrastructure. The stock has repriced significantly. From $90 to $23 is a real reset. If management can demonstrate margin stabilization in Q2 and continued CTV growth, the narrative could shift quickly. The analyst consensus price target sits at $37, with the most optimistic analysts as high as $60. But that upside requires execution improvement, not further deterioration. This is a show-me stock right now, and TTD has a lot to show in the quarters ahead.
The broader advertising market is navigating an unusual moment. Digital ad spend globally is still growing, but macro uncertainty around tariffs and consumer confidence is creating hesitation among large brand advertisers. When budgets get cut, performance-based programmatic advertising is often the last to go. But when brand managers get nervous, even programmatic spend can slow. The Trade Desk is not alone here. The entire ad tech ecosystem faces the same headwind in 2026.
That is Q1 2026 for the Trade Desk. Revenue beat, earnings miss, strong free cash flow, compressed margins, solid long-term positioning with real near-term execution questions. This is a company worth watching closely.
For Charged Alpha, I am Lana.
And I am Hudson. Dive deeper at chargedalpha.com and subscribe so you never miss an earnings breakdown. Stay sharp.
Thank you for listening to Charged Alpha.
Until next time, this content is for educational and informational purposes only. Nothing discussed here constitutes financial advice, a recommendation to buy or sell any security, or an offer to invest. Always do your own research and consult a qualified financial professional before making any investment decisions. Charged Alpha does not hold positions in the securities discussed unless explicitly stated. Past performance is not indicative of future results.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.